Alright everyone, Cowboy Trades here. So there's less than 24 hours until our next FOMC meeting. I know there always seems to be a ton of information to digest ahead of these events. That is why in this episode I'm going to summarize all of the key points that you need to take into consideration to be prepared for the upcoming volatility tomorrow. Now, as always, Cowboys, if you do enjoy this no-nonsense approach to the market, please help me to get these videos trending. Leave a like, leave a comment, share the videos with your friends. It really helps out the channel. And by getting this video trending, you'd be helping others find my content. So enough said, let's jump right in. So starting off from square one, why do the markets seem to have this notion at this moment in time that the Fed is going to pivot? And why is this just plain and simply wrong? Well, to start with this, we need to go back to almost the start of the rally in the S&P 500. Now, if we come down to the lower time frames like the 1 hour, you can see at this specific candle, a certain news event came around that managed to push up the S&P 500 mini futures, you know, the SPX, S&P 500, whatever you want to really call it, up almost 8%. So what was this news article and how did it manage to push us up about 8%? Well, it was simply a news article by the Wall Street Journal reiterating a statement that we had heard the previous month. So I'll read the statement. This was from Fed Governor Christopher Waller. We will have a very thoughtful discussion about the pace of tightening at our next meeting. That's it. That's all he said. We will have a discussion. Now, as that comment seemed pretty ambiguous, I'm going to look at some other unambiguous comments made from other Fed officials to get my point across that the Fed is not going to be pivoting anytime soon. And what better way to start that off on another comment from Fed Waller that was literally 1 week before this ambiguous statement. Now, he said, I am not considering slowing or stopping rate increases due to financial stability concerns. But what about Fed's Mester? Well, she said the following. She said a potential shock could tip the US economy into a recession. She also said, I do not anticipate the Fed lowering interest rates in 2023. This is something that we've heard Powell said many times when he said he doesn't see it coming out until around about March that they're even going to consider pivoting. Fed's Mester also said on this one day, basically went on a whole ramble this day, the biggest policy risk is that the Fed does not raise interest rates sufficiently. So it seems pretty obvious on the Fed stance, but just to be safe, let's read two more. Now, this was after the markets nuked at the end of August. This was a statement by Neil Kashkari. I've probably slaughtered this name, but nonetheless, this is the Minneapolis Fed president. And the Minneapolis Fed president said he was happy to see the stock market's reaction after Jackson Hole. If you don't remember the Jackson Hole event, basically we massively catapulted to the downside as soon as the Fed came out with some very hawkish comments at the Jackson Hole. So I mean, come on, they're literally spoon feeding this to us. But in case there's still any doubt left in your mind, let's read one more from none other than the Federal Reserve Chairman Jerome Powell. Now, Jerome Powell said, we have to get inflation behind us. I wish there were a painless way to do that, but there isn't. And he also said the chances of a soft landing are likely to diminish as the Fed steadily raises borrowing costs to slow the worst streak of inflation in 4 decades. And as you can see, he said we need to raise the cost of borrowing. And what has he been doing? Well, if we come over to the interest rates, you can see 3.25%. This has been rocketing up since basically it's 0.25% that it was residing at for a very long time. Now, ever since then, they've been doing what they've been saying they're going to do month after month, or you know, they're not always every month, but should I say Fed meeting after Fed meeting, they have been raising the interest rates religiously. So look, I could literally do this all day. If you're a seasoned veteran of the channel, then I've already updated you on all of the Fed members' inflation outlooks over the past few months, and keeping everything plain and simple, absolutely nothing has changed whatsoever. Now let's briefly talk about the main takeaways in terms of the current financial conditions, how I see the Fed responding to this massive rally, and then I'll let you know at the end of the video my current stock market and Bitcoin price predictions. So as we just heard from Powell, the cost of borrowing goes up and pain goes up, and like we just showed, interest rates are definitely following suit, just like he's been talking about. So in my opinion, what should we expect tomorrow? Well, nothing other than old reliable, the good old 75 basis point increase. This would basically represent a 25% tightening in the current financial conditions for the US. But not all financial conditions are currently tightening. So in this segment, I want to talk about how the Fed will view this and subsequently respond with their future rate changes. So right off the back, a lot of people seem to have this idea right now that the Fed's goals are to make sure the stock market is booming, to make sure your portfolio is in the green, maintain a strong dollar, and keep interest rates at certain levels. But these are actually not the main goals of the Fed, and the Fed simply uses the interest rates to maintain its main goals. Now, the Fed's main goals are actually to keep unemployment low, keep inflation below 2.5%, and once again, they utilize these tools such as Fed funds rates to promote a 2 to 3% annual increase in gross domestic product. I'm going to leave the talks about GDP out because I don't want to talk about GDP. I'm sure none of you want to talk about and listen to me talk about GDP either. So yeah, the Fed simply used the interest rates to change the cost of borrowing, which affects the profitability of government debt in the bond market, which then affects the strength of the dollar, which then affects the stock market. It's one big, boring loop that you'll learn about if you've ever studied economics, but nonetheless, now we've got that out of the way, we know the type of data that the Fed is going to be looking at to help inform their positions. So let's look at the United States unemployment rate. This has basically, in the past year, been very, very steadily decreasing from 4.2% last November all the way down to, well, 3.5%. Now, if I was a Fed policymaker and I was looking at the unemployment rate, I'd be feeling pretty good. After all, I mean, our job is to keep unemployment low, and when there's more workers in the markets, it means the US can push outwards its production possibility frontier, basically meaning they can produce more goods and services without any changes in investment. And with all that, once again, with the unemployment rate coming down to very, very healthy levels, there doesn't really seem to be any reason to pivot. You know, there's no holes in their monetary policies right now, at least in terms of unemployment. Now, when we head over to the financial conditions in the form of the IEF-LQD ratio, this is a chart that you can get over on the NASDAQ to look at the financial conditions in the markets right now. So this is very simple. I've included a key for you down over on the left side of the screen. Basically, when the IEF-LQD ratio pushes to the upside, this means financial conditions are tightening. Now, you can really see the levels that we're at right now are kind of rallying, or they're kind of showing up against the 2008 rally when we were in that massive recession. So we're definitely at somewhat tight monetary policy in terms of previous monetary policy that we've had. But another interesting way that we haven't looked at this before is actually to look at the Chicago Fed National Financial Conditions Index. Now, basically, when this index is above 0%, this means we're moving into restrictive territory. And when we're beneath this 0% ratio, it means that we're in accommodative territory. So basically meaning, you know, when the economy, or basically should I say, when the Chicago Fed National Financial Conditions Index is beneath this 0% ratio, it means it's going to be accommodative monetary policy. So, you know, if you're a new business and you're looking to raise capital either in the equity markets or you're looking to take out a loan, you're not really going to have a hard time doing that in accommodative markets. But when the interest rates get raised and raised and liquidity is draining out of these markets, when these restrictive policies start to tower over inflation, we actually move into restrictive territory. So you might be wondering, you know, when we're looking at the IEF ratio, we're moving up quite strongly. When we're actually looking at things like the United States interest rates, they are very, very strongly moving up to the upside, around about 3.25%, and I'm expecting they're going to move into 4% tomorrow. But why does it make sense that we're currently still in very accommodative territory? Well, let me ask you this. If we raise the interest rates by 75 basis points to combat inflation, and let's say hypothetically, you know, once again, very hypothetically, just pulling this number out of my head, let's say inflation is at 100 basis points, inflation increases by 100 basis points every time we've got an FOMC meeting, and all we're doing is raising interest rates by 75 basis points. You can see, you know, the problem with that, right? Because, you know, we're not actually raising interest rates at a high enough level to combat the inflation that we're currently left with. So at this moment in time, you know, we've been looking at this channel, we've been looking at how inflation is doing. When you come over to the sticky price CPI, you're seeing more slower moving categories of inflation. So if we get rid of the flexible CPI, which was this line up here, you can see slower moving categories known as the sticky price CPI are still continually moving to the upside and making new cycle highs. Now, in terms of headline inflation and core inflation actually pushed up very, very strongly last time. We talked extensively about that when this did happen, but nonetheless, headline inflation as well, which is, you know, what you do want to take away from this, is still around about 8.2%. Now, this has been coming down from its highs of 9.1%, but really it's been coming down at a very, very slow rate. And, you know, once again, when you're thinking about this from a logical perspective, raising the interest rates by 75 basis points when inflation is much higher than 75 basis points, it's no surprise that we are still in accommodative territory. And typically, you know, when you come back to these, you know, previous recessions, you know, once again, yeah, for a better word, recession, when you're really in these very bearish, restrictive territory in market policies, you know, you tend to come up above this line and then you tend to come back down. And once you go back down beneath this line, you can be fairly certain that we've moved into the restrictive territory. The Fed has done whatever monetary policy changes they need to do. And then, you know, it's time to move back into more accommodative territory. But at this moment in time, you know, the Fed's goals are once again, one of their main goals, as I said earlier, is to make sure inflation is beneath 2.5%. How are they going to do this when inflation is running rampant and they're still in accommodative territory? Well, there's only one answer to that, my friends. They need to continue increasing the interest rates. Now, building onto that previous point, basically still talking about liquidity conditions, I'm sure everyone's recently seen Bitcoin and the stock market take this massive run to the upside like we talked about right at the start of this video. I talked briefly about why this happened in my Discord. Basically, a lot of options were expiring at the end of the month. Short coverings took place. There was also a lot of stock to sell in the first week of November, so we could have been pricing that in. We could have been pricing in that extra liquidity in the market. So in the past month, if we're looking at the E-mini futures, let's look at the past month today. So let's look at the 1st of October, basically until the end of October. Let's look at what happened. And wow, here you go. Here you can see the top of the book in the book depth. You can look at the mid price. You can basically see, eyeballing this, liquidity massively inflowed into the markets. Now, I really don't think this has changed anything in the higher time frames. Once again, we talked about these, you know, systematic outflows. We talked about, you know, the options expiring. We talked about the short coverings. And then also, if you're coming over to a higher time frame picture anyway, like for example, when we're looking at the year to date, looking at January 1st up until right now, you can see, you know, we've had these bounces in the mid price and the book depth many, many times. And this is normally always an increase in liquidity. It typically happens round about the end of the month, which is very, very interesting. Over here you can see on the 2nd we had a massive inflow of liquidity. This could have been from an options expiration. This could have been from a MOC imbalance. Over here you can see 31st of March, this was a massive inflow. This was literally running up in liquidity round about the 1st of February. Over here this was halfway through the month, so this is a deviation from the rest of this, but nonetheless, once again, we're running up in terms of liquidity at the start of the month. Now, this is not a new phenomenon. This is probably going to keep on happening. This is why when you look at the higher time frames, you can see every time this does happen, we're always presented with a macro lower high. Now, I'm just going to wrap up the last few charts super quickly. I did originally record these with much more in-depth TA, but then I realized the video was longer than normal, or it was normal content, but I do want to make this video quicker than normal so I can really get the point across as quick as possible. So I'm not going to talk about the fundamentals too much, but typically looking at the Bitcoin active addresses, we've talked about this many, many times on the channel. Active addresses top out, it normally correlates to a massive landslide in the Bitcoin price action. Now, if we're simply looking at the active addresses from this cycle, so you can actually see back in 2017 active addresses topped out, you know, lots of senders and receivers in the network moving their coins about. That is when the Bitcoin USD price topped out and rolled to the downside. If we're specifically looking at this cycle, you can see active addresses fired when Bitcoin was at 59,000. They fired again when Bitcoin was at 65,000, and then since then active addresses run up, but the next time that it fired, Bitcoin was trading at around about 33,000. The time after that, which is right now, Bitcoin active addresses are running up and Bitcoin is trading at 20,400, 20,500. So you can definitely see when these Bitcoin active addresses start to run to the upside, it's not looking good. But once again, this is not one of the main takeaways from this video. I did just want to let you know. In terms of the SPX as well, like we talked about earlier, the SPX running to the upside, the stock market running to the upside, the markets entering a risk-on phase, even in the immediate short term, is counterproductive to the Fed. They need the markets to move into they need the markets to move into restrictive territory. You've got to imagine, for example, let's pretend that we were in restrictive territory already so I can really get this point across. If we were in restrictive territory already, this would mean that governments would be looking, or the Fed would be looking to move to accommodative territory. How would they do this? They'd lower the interest rates. What do you think would happen when they lower the interest rates? Bonds will go down. The US dollar will go down. But what will happen? It will encourage investment. It will encourage borrowing. New businesses will either look to float their shares on the equity markets. People, will look to buy on those risk-on buys. And even if they can't raise shares in the equity market, they can go and ask the Fed, they can go and ask the government, they can go ask their bank for money to borrow when we do come down to these accommodative territories. So you can imagine if we were hypothetically trading in restrictive territory, what would the government want to see, what would the Fed want to see for us to come down to these accommodative territories? They would want to see interest rates go down, and subsequently the stock market would start to bounce back up, and because the stock markets are rallying, because risk on markets are rallying, we would be in accommodative territory. So you can really see how this would work the complete opposite way when we're already in accommodative territory and we're trying to move towards restrictive territory. The market's breaking into a risk-on phase where, the S&P 500 has increased liquidity and is starting to run to the upside. That works against the Fed trying to move us into restrictive territories. But that is really all I've got for you. In terms of the SPX and Bitcoin, like I said, I'll wrap up on the price predictions I think for this. I do think the SPX is going to start rocketing down into new lows very, very soon, and this SPX of 2008 fractal that we've been following has been, more accurate than every single YouTuber in the entire space, including myself, because I personally said that I think this bounce was about a week off, and technically it was like 3 or 4 days off, so I was really only a couple of days early on this, or a couple of days late in terms of predicting the bounce. But as you can see, the S&P 500 chart, this does not play around. Every bounce, every top, every bottom, it's been calling. So I'm looking at this. We've also looked at the lined up version from January 1st to January 1st. They both called a rally based on the October earnings season, but this chart is predicting in the next couple of weeks, maybe even now, for us to start rolling to the downside. I think we're going to come down to new lows very, very soon. In terms of Bitcoin, I'm already in an active short from 20,200. I will be very, very happy if price moves to the upside because I'm using low leverage. I'm actually hoping price pushes up so I can short from this 22,000 range. I'm also looking to short from around about 21.8 in a smaller trade, just in case we don't come all the way up to 22. But nonetheless, if we push up in the immediate short term, I'll be entering new shorts from higher levels, so I'll be very happy. If we start breaking to the downside at this level, at this moment in time, my short will start going into profit. So I'm happy either way. I'd prefer a liquidity grab so I can be running, 3 or 4 trades instead of just this one trade that I'm running on Bitcoin at this moment in time. So really all I see in terms of Bitcoin, I see us pushing up. Yes, we have broken out of this triangle pattern, but nonetheless, everything else that we're looking at, I think the stock RSI looks like it's about to massively flow back down to the downside. Yeah, it has already crossed bearish, and you can see a lot of these tops in the price action actually beautifully correlate to these tops over in the stock RSI. You can see this breakdown over here. You can see this top here, this breakdown over here. You can see this double top, but I'm looking at the macro market structure, so you can still see from here and here and here and here. We just have a range of lower highs, and every single time we do this, we're normally at very extended territory, and the stock RSI goes all the way down to basically, zero, all the way down here. So in my opinion, looking at Bitcoin, I think Bitcoin's going to start breaking to the downside. If you're not already in my short, then you're not already in my Discord, or if you are, you haven't got notifications turned on. So make sure to come and join the Discord. I'm currently shorting Bitcoin down to 19,000. I do recommend caution if you are trading before the FOMC meeting. I'm personally using 5x leverage because I know that when these FOMC meetings come out, you can have these knee-jerk reactions. It can be bearish news and we can shoot up 1-2%, and then we can nuke like 10% in the next day or so. So these markets can be very volatile. So if you are shorting on an FOMC, if you are longing, whatever you're doing, make sure you're managing your risk. I'm personally more on the sidelines right now. My trade is very low leverage and low capital, but nonetheless, I hope to see you over in the Discord. That's all I've got for you today, Cowboys. If you do want to come and join the Discord, head over to my YouTube channel, click on About, and you can see the links for my Twitter, Discord, Instagram, and official merch are all there. Reason for following my Discord and my Twitter are also that I do post news events in a timely fashion. So when we do have the results for the FOMC meeting, I will be posting them on both Twitter and Discord. If I do enter a trade while I'm away from my keyboard, I will be letting you know about that over on my Discord. But for now, Cowboys, that's all I've got. Best of luck tomorrow with the volatility. Hope you enjoyed today's video. If you did, of course, make sure to smash that like button. Cowboy out. Peace.